Okay, your next most important lesson, in your syllabus, variance analysis. Then this is the most important one when we consider about your syllabus, variance analysis, because under the management accounting our main purpose is what? Main purpose is providing information to our management for the purpose of taking their decision. No? Then this variance analysis is the another most important thing, that the most important information that we can provide to our management. Then under the variance analysis, mainly we try to identify difference between our budgeted or standard details with our actual details. Simply we can say this as a difference between our budgeted data and actual data. I hope you can remember when I discuss flexible budget. When I discuss flexible budget, I told you then we can calculate difference between our actual data and flex data. Then difference between this actual data and flex data we can call as a variance. That means the variance between the actual data and flex data. Then like this, in this situation also we try to identify this difference between our budgeted data, that means flex data, with our actual data. Then I will simply example then overall idea about this variance analysis and what are the final output or why we perform like this variance analysis. Then using this simple example I will give brief idea about variance analysis. Okay, then let's assume then our budgeted number of unit is 1000, then per unit material consumption is 2 kg, then cost of 1 kg is 75 rupee. That means we can get our total budgeted material cost. We can get our total budgeted material cost as how much? Our budgeted number of unit is 1000, then per unit material consumption is 2 kg, then we can multiply it by 75. Then we can get what? Total budgeted material cost. Total budgeted material cost 1000 multiplied by 2 multiplied by 75, we can get it as 150,000. Then our total budgeted material cost we can get as 150,000. Then our actual data we have, then as per the given detail they say actual number of unit is 850 unit. Then per unit material consumption is 1.8 kilogram. That means our actual material consumption is 1.8 kilogram, and per kilogram actual price is 72. Then you can see when we consider this normally when we compare budgeted details with actual data, you can say our per kilogram price is 72 but our budgeted one is 75, and when we come to the material consumption also, then when we come to the budgeted detail is a 2 kilogram, but when we come to the actual one it is a 1.8 kilogram. Then simply we can calculate our total actual material cost. Then how can we get total actual material cost? We produce 850 unit, per unit material consumption is 1.8 kilogram, and per kilogram cost is 72. Then we can get our total actual material cost as 850 multiplied by 1.8 multiplied by 72, then we can get as 110 and 160,000. 110 and 160,000. This is the actual data. But can you remember, I told you normally we can't compare this budgeted data with actual data, because this budgeted data is based on what? Based on our budgeted number of unit of 1000, but our actual number of unit is 850. If we compare this 150 is 110,000 and 160, it is not fair. Then what did I do for that? Then I convert this budgeted data into our actual data. That means simply I calculate what? Flex budget. We calculate flex budget. Then how can I calculate flex budget? Normally I can calculate 150,000. We can divide it by 1000. That means our budgeted number of unit, and then we can multiply it by 850. That means our actual number of unit. Then 150,000 divided it by 1000. We can multiply 850. Then we can get our flex budget as 127,500. 127,500. Okay, then we can calculate our flex budget at 127,500. Then we can compare this flex budget with our actual details. Then we can compare this flex budget with our actual detail. Then as per our comparison, then we can identify our flex one is 127,500, but our actual one is less than this, that 10,160. That means we have 110, 160. Our difference is 17,340. 17,340 is our difference. That means we have favorable or adverse difference. That means as per our flex detail, we hope to incur 127,500, but our actual one is 110. That means we can identify this as a favorable one for our organization. That means 17,340 favorable variance we can identify. Actually, this identification, that means identify this variance is simple, but this is the main variance that we can identify with comparing our flex budget with actual budget. No, but actually we can further analyze this difference. We can further analyze this difference. That means we can identify the main reason. That means the main factor that affected to this variance. That means this variance can be driven by main two reasons. First one, change in our price, or the changes in our material price. Then actually when we compare our budgeted per kilogram price with our actual price, then you can see there is 3 rupee change. 3 rupee change. That means our budgeted one is 75. Our budgeted one is 75, but our actual kilogram price is 72. That means we can identify 3 rupee difference between our budgeted data and actual data. 3 rupee difference. That means this difference is driven by the main factor that affects this difference is our price change, as well as another thing that affected to for this difference is our material usage. Then if you compare our material usage with budgeted and actual data, then definitely we can identify some difference between those things. Okay, then actually we can deeply analyze further. We can analyze this 17,340 difference using this variance analysis. That means under this lesson we hope to further analyze these variances. That means what are the main reason for these variances. Then it can be price change, or it can be quantity change, or in this case it can be the per kilogram price change, or otherwise it can be what? It can be our material usage. That means kilogram usage change. Then we need to identify what is the main thing that affected to this difference. Like this we can further analyze then using this variance analysis. That's the main purpose of this variance analysis. Then under the variance analysis, we have to mainly calculate three type of variances. Then when we talk about variance analysis, we have to discuss mainly three type of variances. That means first variance is variable cost variances. That means regarding our variable cost, that means labor, then our material cost and other overhead. Based on this variable cost, then we can calculate our variance. That means under the variable cost we have another three type of variance: direct material variance, direct material cost variance, then direct labor cost variance, and variable overhead variance. That means under the variable cost variances we have to learn main three types of variances: direct material cost variance, direct labor cost variance, and variable overhead cost variance. Under these again, that means under the direct material cost, again we have two sub variances as I mentioned. Then as per this example, then our total variances is that much. No, then we can identify the main reason for this difference. That means what's the main reason for this difference? Is it price change, or it is a our quantity change. Like this we can identify these things. Then for that purpose, then again we can calculate sub variances or the sub related variance for this direct material cost variance. That means material price variance and material usage variance. We can calculate material price variance and material usage variance. Like this for the labors also we can calculate. Actually, when we come to the labor cost, this labor cost difference mainly driven by due to the change of our rate per hour rate to otherwise the usage of hours. Therefore, we can calculate sub two variances regarding our direct labor cost. That means direct labor rate variance and direct labor efficiency variance. We can calculate direct labor rate variance and direct labor efficiency variance. Then when we count the variable overhead also, we have two types. Variable expenditure variance, normally we say at variable expenditure variance and variable cost efficiency variance. Like this, there are also two type of variance. Then I hope to further discuss about this thing. Then now I go give you to the some kind of the summary, summarized version about variances that we have to discuss. Okay, that means under the variable cost we have to discuss these three variants. Under that we have another sub variance 6 variances. Okay, then you have to learn these things. Then when we come to the second type of variance is fixed cost variance. Fixed cost, this is for variable cost. Then we have to calculate variance for our fixed cost. Then under the fixed cost we have to calculate two type of variance: fixed expenditure variance and fixed expenditure variance and fixed volume variance. We have to calculate fixed expenditure variance and fixed volume variance under the fixed cost variances. Then third type or the third category that we have to learn under the variance is sales variances. Sales variances. Then when we come to the sales variances we have to calculate mainly two type under your BL6 management accounting. Okay, but we have further when we come to the direct material, under the direct material cost, then direct material usage, then we have another further sub variances. That means we have mix variance and like this subcategory. Then under your BL6 management accounting we don't hope to discuss these things. We only discuss about these variances. Okay, then when we go to sales variances, we have sales price variance and sales volume variance. Like this, these are the things that you have to learn under this lesson. That means you have to learn all of those variances under this lesson, and based on these variances then you have to learn how can we prepare reconciliation for reconcile our budgeted profit with our actual profit. Like these things you have to learn under this lesson. Mainly you have to focus on these variances. Okay, I hope you got idea about what is the meaning of variance analysis and what is the purpose of variance analysis. Then under that we have to calculate those variances. Then let's discuss these variances one by one. Then based on these variances one by one, then how can we calculate those things. Okay, then let's first move on to direct material variance. Then I hope you can remember the diagram that I show you. Then as per that diagram, then we have to discuss variable cost variance. Under that, first variance that we have to discuss is direct material variance. Then under the direct material variance, we have total direct material variance, main variance. Under that we have two sub variance: direct material price variance and direct material usage variance. Then direct material total variance, so our direct material variance mainly it is focused on to identify the variance between our actual data and our budgeted data. That means identify the total variance, total material variance. Okay, then as I mentioned, this total material variance is mainly this material variance is mainly driven by due to many reasons. Actually, we can identify the main two reasons that are affected on this total material variance. First one is, as I mentioned, price change or the our per kilogram price change, or other thing is our usage or our material usage variance. Okay, the changes in our material usage and changes in our material price, those two things directly affect on our direct material variance. Therefore, for the purpose of identify how about their price variance and how about their usage variance, for that purpose we calculate two separate subvariance called direct material price variance. Actually, price variance, this price variance mainly focus on identify the how about the price changes affected on our direct material variance. Then second sub variance is direct material usage variance. When we come to direct material usage variance, it is mainly focused on the usage change. That means how about the direct material usage change, then how it affect on our direct material variance. Then these things we focus on the direct material usage variance. Okay, then for the purpose of identify the main variance or the main direct material variance, to identify the main sub-factors, we calculate direct material price variance and direct material usage variance. Then most important thing is then how can we calculate those direct material total variance, then direct material price variance and direct material usage variance. Then simply we can calculate our direct material variance. Then how can we calculate? Standard cost on actual production. Standard cost on actual production minus actual cost. Standard cost on actual production minus actual cost. Then actual cost directly we can get from our questions. Okay, then we can get directly our actual cost. That means actual cost that we incurred for the material directly we can get. Then how can we calculate standard cost on actual production? How can we calculate standard cost on actual production? Simply we can calculate standard cost on actual production. How can we calculate? Actual number of production units. Actual number of production units, we can multiply it by per unit standard cost. Simply we can calculate standard cost on actual production. Then how can we calculate? Actual number of production units, we can multiply it by what? We can multiply it by per unit standard cost. Then we can get standard cost on actual production. Then difference between standard cost on actual production and actual cost, we can get as what? Our direct material variance. We can get as our direct material variance. Okay, it is a simple. Simply we can calculate our direct material variance as the difference between standard cost on actual production and actual cost. Okay, then I hope you realize the way that about this equation. Okay, then I hope to discuss examples. Then using this example again, you can realize the way that how can we calculate. This is the first equation that you should keep in your mind. Under the variances, how can we calculate direct material variance? Then as I explained, this direct material variance mainly is driven by due to two factors. One factor is price change and other factor is usage change. Then for that purpose we can calculate direct material price variance and direct material usage variance. Then how can we calculate direct material price variance? Simply we can calculate our direct material price variance actual material purchase. That means actual number of material purchase. It can be kilogram, liter or whatever. Then actual material purchase, we can multiply it by difference between standard price and actual price of that material. That means if we consider kilogram, then per kilogram standard price and difference between per kilogram standard price and per kilogram actual price, then we can multiply it by actual kilogram usage. Actual kilogram usage of purchase. Then we can calculate what? Direct material price variance. Then we can calculate direct material price variance. Okay. Then how can we calculate direct material usage variance? Then that means how about our usage affected on our direct material variance? Simply we can calculate direct material usage variance. How? Standard price, that means per kilogram standard price, we can multiply it by standard usage on actual production minus actual usage. This actual usage we can directly get from our questions. Okay, then directly we can get how about our actual material usage. Then how can we get standard usage on actual production? Simply we can calculate standard usage on actual production. How can we calculate? We can multiply our actual number of unit produced, actual number of unit produced, we can multiply it by what? We can multiply it by per unit standard usage. We can multiply it by per unit standard usage of material. That means, how about the per unit standard usage on kilogram? That means, if we have kilograms, then how about the per unit kilogram standard usage? This should be, we should multiply it by actual number of unit produced, then we can get standard usage on actual production. Then difference between standard usage on actual production and actual usage, we can multiply it by standard rate, then we can get what? Then we can get our direct material usage variance. Direct material usage variance. Okay, these are the sub variances that we have to calculate under the direct material variance, direct material price variance, and direct material usage variance. Then actually summation of all of those things, that means direct material price and direct material usage variance, summation of those two things should similar to the direct material variance. That means another way that we have to calculate direct material total variance is summation of direct material price variance and direct material usage variance. Summation of those two things we can get as our direct material total variance. Okay, this is the another way that we can use to calculate direct material variance. Okay, I hope you realize the way that we can use to calculate these variances, and most important thing about these formulas. Okay, definitely you should keep in your mind this formula. Then one thing is, if you can realize the rationale behind this, definitely you can keep this in your mind. That means under the direct material price variance, we try to identify what? We try to identify our price variance. That means how about the price variance affect impact on our direct material variance? No, therefore we mainly focus on our price variance. Therefore simply we get difference between our standard price and actual price. That means per kilogram standard price and per kilogram actual price, and then we can multiply it by actual material purchase. Then we can get our direct material price variance. When we come to the usage variance we mainly focus on the identify about the usage variance. How about the usage variance? Then for that purpose we should consider about usage. That means we should take the standard usage on actual production and difference between standard usage on actual production and actual usage. Then how can we take standard usage on actual production? Simply actual number of unit produced we can multiply by per unit standard usage. Then we can get this one. Then difference between these things we can multiply it by standard rate. Then we can get direct material usage variance. Okay, these are the formulas that you have to calculate direct material total variance, then direct material price variance, and direct material usage variance. Okay, then let's see using example further how can we calculate these things using available information. Okay, then let's move on to this example. Okay, using this example, then let's see how can we calculate a direct material variance, then direct material price variance, and direct material usage variance. Then we have standard details for direct material. Then our per unit cost is 450. Our per unit cost is 450. Then it is required 2 kilogram per unit. For the purpose of producing this, it is required 2 kilogram per unit. Then 1 kilogram is 225. Then our per unit cost is, we can get 225 multiplied by 2, 450. Then we have budgeted production 1000 units. Then our budgeted production is 1000 units. Then we have actual details. Then direct material purchasing. Our total cost is 462,000. Then we purchase 2100 kilogram at 220 per kilogram. That means our 1 kilogram price is 220, and totally we purchase 2100 kilogram. Then our actual production is 950 units. Then based on this detail, first we have to calculate our direct material variance, then direct material price variance, and then direct material usage variance. Then first we can calculate our direct material total variance. Then how can we calculate it? Standard cost on actual production minus actual cost. Then directly we can get our actual cost. How about our actual material cost? Directly our actual material purchasing cost is 462,000. No, 462,000. That means our actual material cost is 462,000. then we have to calculate what? Standard cost on actual production. Then how can we calculate the standard cost on actual production? Simply we can calculate the standard cost on actual production. Actual number of production units multiplied by per unit is standard cost. Then how about our actual number of production units? Our actual number of production unit is 950 units. Then our actual number of production units is 950 units. Then we can multiply it by per unit is standard cost. How about our per unit is standard cost? Per unit standard cost is 450, no? Then per unit direct material standard cost is 450. Then we can multiply this by 450. Then we can calculate what? Standard cost on actual production. Standard cost on actual production. How can we get is actual number of production units, that means 950 units. We can multiply it by per unit standard cost. Per unit standard cost is 450. Then 950 multiplied by 450, we can get it as 427,500. 427,500. Then we can get our actual standard cost on actual production as 427,500, but our actual cost is how much? 462,000. Then we can get our variance as 34,500. Then our variance is 34,500. Then is it favorable or adverse? Then when we consider the standard cost means that the cost that we hope to incur is 427,500, but our actual cost is 462, no? That means actual one is higher than our hope or our standard one. Therefore, definitely we can identify this as a adverse variable, or otherwise, since we get the negative figure, simply we can say this as what? Simply we can say this as the adverse variable. Then like this we can calculate our direct material variance, total variance, standard cost on actual production minus actual cost. Then we can move on to our sub variances, that means direct material price variance and direct material usage variance. Then how can we calculate direct material price variance and direct material usage variance? Simply we can calculate direct material price variance, actual material purchased, that means as per our actual details, how many number of how many kilograms we purchase. We purchase 2,100 kilogram, no? 2,100 kilogram. That means our actual material purchase is 2,100 kilogram. Then we can multiply it by per kilogram standard price. How about our per kilogram standard price? As per the given detail, 1 kilogram is 225. That means our standard price is 225, but our actual one is, as per the given details, our actual price per kilogram is 220. That means our actual price is 220. Then we can calculate simply our direct material price variance, actual material purchase 2,100 kilogram. We can multiply it by standard price of difference between standard price and actual price of 225 minus 220. Then simply we can get 225 minus 220 multiplied by 2,100, that means 10,500. We can get it as 10,500. Then this 10,500 is it favorable or adverse? Simply we can say this as a favorable one. Why? Our standard rate per kilogram is 225, but actual one 220. That means our actual one is less than standard one. Definitely this is favorable for our organization. That means even our total direct material variance is adverse when we consider about the price change. Actually it is affected as positive one, no? It is affected as a positive. It is make positive impact on our business. Then when we come to the direct material usage variance, then how can we calculate standard price? We should multiply it by standard usage on actual production minus actual usage. Then we can calculate direct material variance. Then standard price per kilogram standard price is 225. Then we can multiply it by standard usage on actual production. Then how can we calculate standard usage on actual production? we should multiply our actual number of units by per unit standard usage, per unit standard usage. Then how about our actual number of production units? 950, no? Then our actual production unit is 950. Then we can multiply this 950 by per unit standard usage. How about our per unit standard usage? Then they say 2 kilogram per unit. This is the standard usage per unit. Standard usage per unit is 2 kilogram. Then simply we can multiply it by 2. Then 950 multiplied by 2. Then we can get as a 1900. Then standard usage on actual production is 9100. Then we can deduct our actual usage is how many kilogram? 2100 kilogram. Then our actual usage is 2100 kilogram. Then we can get our variance as 1900 minus 2100 multiplied by 2 to 45,000. Then we can get it as 45,000. This 45,000, is it favorable or adverse for organization? Definitely this is adverse for organization. Why? This is our standard usage. That means the standard number of kilogram that we hope to use, but actual one is higher than this. Therefore definitely this is adverse for organization. That means this usage of our direct material make negative impact on our direct material variance. Simply then only if we calculate this direct material variance, only we can see this total variance. That means we can see then totally our direct material cost when we consider about our profit or when we consider about our performance, then only we can see then direct material variances make negative impact on our profit. That means as we budgeted this amount but our actual one is this one, that means we have negative impact on our profit 34,501. But when we further analyze, then we can see actually our price variance. So the price changes make some kind of the positive impact. It's a 10,500 favorable one. But mainly usage, that means when we consider about our efficiency, and then there is some issue. That's why we have like this adverse amount like this. Then we can analyze these details like this. We can analyze these variance details. Okay, based on that, then we can take different kind of the decisions. Okay, different kind of the decision. Okay, this is about direct material variance. Actually under your BL6 only we have to discuss these things, but when we come to the direct material usage variance, we have another sub variances called direct material mix variance and direct material efficient variance. Like this we have another two sub variants under the direct material usage variance, but under your BL6 we don't hope to discuss, we only hope to discuss those two sub variances. Okay, these are about that we have to discuss under the direct material variance. Okay, next we can move on to the second variable cost variance, labor cost, direct labor cost variance. Then we have discussed direct material cost variance. Then we now we are discussing about direct labor cost variance. This direct labor cost variance combination of direct labor rate variance, then direct labor efficiency variance and idle time variance. The combination of all of these three variances, then we can identify as a direct labor cost variance. Then under this direct labor cost variance, we try to identify variances regarding the direct labor cost. That means then if we identify some rupees variance regarding the direct labor cost, then we try to more analyze this direct labor cost related variance. That means we try to identify how impact on this variance from our direct labor rate, that means based on our payment, and otherwise then we try to identify how about impact from our direct labor usage or the working times or the working hours. Then based on this, then we try to identify or try to analyze this direct labor cost variance. Okay, that's the reason we identify three separate sub variances regarding the direct labor cost variance, direct labor rate variance. Actually this direct labor rate variance mainly focus on to identify how about impact of this direct labor rate or the salary rate on this variance, and direct labor efficiency variance, it is mainly focused on how impact from our labor hours usage, and idle time variance, it is normally we calculate based on the idle time. Then if we have any idle time, then simply we can calculate the idle time variance. Then based on those things we try to identify the variance about variance of our direct labor cost variance. Then first let's see how can we calculate direct labor cost variance. Simply we can calculate direct labor cost variance, standard cost on actual production minus actual cost. Standard cost on actual production minus actual cost. Then directly we can get actual cost. That means normally when we come to your questions, then normally they provide actual cost, but we need to identify standard cost on actual production. We need to identify standard cost on actual production. Then how can we identify the standard cost on actual production? Simply we can calculate standard cost on actual production. We can multiply our actual number of unit produced, we can multiply it by standard cost per unit. We can multiply it by standard cost per unit. Normally when we come to your questions, they provide standard cost per unit. Then we can multiply standard cost per unit by actual number of unit produced. Then we can get what? Then we can calculate standard cost on actual production. Then difference between the standard cost on actual production and actual cost, we can identify as the labor cost variance. Okay. Then as I mentioned, we have three another sub variances under the direct labor cost variance. Then direct labor rate variance, and direct labor efficiency variance, and idle time variance. Then when we come to direct labor rate variance, then how can we calculate direct labor rate variance? Simply we can calculate direct labor rate variance. We can multiply actual labor hours. Normally they paid, okay. Then actual labor hours we can multiply it by difference between standard rate per hour and actual rate per hour. That means difference between standard rate per hour and actual rate per hour, we can multiply it by actual labor hours. Then we can calculate what? Direct labor rate variance. It is simple. Simply we can calculate how direct labor rate impact on our total variance. Then second, our subvariance is direct labor efficiency variance. Then how can we calculate direct labor efficiency variance? Simply we can calculate direct labor efficiency variance. We can multiply the standard rate per hour by difference between standard usage on actual production. Standard hours usage on actual production minus actual labor hours work. Most important thing is actual labor hours work. We need to get actual labor hours work. Then when we come to this point, then actual labor hours, normally we get paid actual labor hours, but normally then actual labor hours paid and work hours can be difference based on the idle time. That means if there was some idle hours, then definitely paid hours and work hours there are difference. There is difference, okay, because our actual work hours and paid hours, that means if normally we paid for idle time also, therefore our paid hours can be higher than the work hours, okay. Therefore when we calculate direct labor efficiency variance, we need to get what? Actual labor hours work. Normally in this point we get actual labor hours paid. Normally we paid for both work hours as well as for the idle time or the idle hours, okay. Then when we come to this direct labor efficiency variance, we need to consider about actual labor hours work, okay. Then we can get our direct labor efficiency variance, standard usage on actual production minus actual labor hours work, we can multiply it by standard rate. Then how can we get this standard usage on actual production? Then normally actual labor hours work they directly provide, okay, therefore we can directly get it. But when we come to the standard usage on actual production, Then how can we calculate this standard usage on actual production? How can we calculate? Simply we can get standard usage on actual production. We can multiply it actual number of units produced by what? We can multiply it actual number of unit produced by per unit standard labor hours usage. We can multiply it by per unit standard labor hours usage. Normally we can get it also directly they provide, okay. Then standard labor hours usage per unit they directly provide. Then we can multiply it by actual number of unit produced. Then simply we can get what? Then simply we can get standard usage on actual production. Then difference between standard usage on actual production and actual labor hours work, we can multiply it by our standard rate per hour. Then we can get what? Then we can get direct labor efficiency variance. Then we can get direct labor efficiency variance, okay. Then most important thing is you need to keep in your mind, then when we get actual labor hours for this point, we need to get what? Actual labor hours work, okay. Actual labor hours work, that is the main important thing. You need to get actual labor hours work, okay. This is about direct labor efficiency variance. Then third subvariance of direct labor cost variance is idle time variance. Idle time variance. Then when we come to idle time variance, then normally if there was some idle time or the idle hours, then definitely we need to calculate idle time variance. Then how can we take idle time variance? Simply we can multiply our idle time, so the idle hours, by standard rate per hours. Standard rate per hours. Then we can get what? Then we can get our idle time variance. Then we can get idle time variance. Then we can multiply idle time, so hours, by our standard rate per hours. Then we can get what? Then we can get our idle time variance, okay. This is our third one, third subvariance. Then combination of all of those three variants, we can get what? We can get as direct labor cost variance. That means simply direct labor rate variance plus direct labor efficiency variance plus idle time variance, all of summation of all of those things we can get as direct labor cost variance. Summation of all of those things we can get as direct labor cost variance. So otherwise, using this formula, then we can calculate simply standard cost on actual production minus actual cost, okay. Then let's move on to example. Then using example, let's see how can we calculate those things. Then let's move on to our example. Then we have details for the product X. They say following details relevant to the product X. Then we have standard cost for the product X. Standard cost for the product X. We have direct labor cost. Then direct labor cost 8 hours per unit. That means they utilize 8 hours per unit at 1500 per hour. That means they budgeted, or their standard cost per hour is 1500. Then per unit 8 hours they utilize, and per hour 1500. Then we have actual details, that for the this product we have actual details. Then actual number of production units 2000 units. Then actual number of production unit 2000 unit. Then actual labor hours work. Most important thing is actual labor hours work. They work 15,000 hours. They work 15,000 hours. And also we have actual cost. Actual cost for the month. Then when we consider the actual cost per the month, they say they paid for 15,500 hours, 2000 per hour. That means they paid for 15,500 hours. Then per hour rate is 2000. Okay, these are the details available. Then we have our standard cost, as well as we have our actual details. Then based on these available details, then let's calculate direct labor cost variance, then direct labor rate variance, then direct labor efficiency variance, and idle time variance. Okay, then first direct labor cost variance. Then how can we calculate direct labor cost variance? Simply we can calculate direct labor cost variance, standard cost on actual production, minus actual cost. Then directly we can get actual cost. Then how can we get actual cost? Actual cost is they paid for 15,500 hours. Per hour is 2000, per hour rate is 2000. Then simply we can multiply 15,500 by 2000, then we can get our actual cost as 31 million. Then our actual cost is 31 million. Then I get it as in 1000. Okay, then our actual cost is 31 million. Then directly we can get our actual cost as 31 million. Then how can we find or calculate standard cost on actual production? Standard cost on actual production. We can calculate standard cost on actual production multiplied our actual number of unit produced by standard cost per unit. Then our actual number of unit produced, how about our actual number of unit produced? They say it as 2000 units. They say it as 2000 units. Then we can multiply 2000 units by standard cost per unit. Then how about our standard cost per unit? Then when we come to our standard cost details, they say they utilize 8 hours per unit. They utilize 8 hours per unit. Then per hour rate is 1500. That means 8 hours multiplied by 1500, we can get what? We can get standard cost per unit, because as per their budgeted details, they hope normally per unit they utilize 8 hours and per hour rate is 1500. Then we can multiply 8 hours by 1500. Then we can get 12,000 as our per unit standard cost. Then our per unit standard cost is 12,000. Then our per unit standard cost is 12,000. Then 12,000 multiplied by 2,000. Then we can get it as 24 million. 24 million. Then standard cost on actual production is 24 million. Then how can we get actual number of unit produced multiplied by standard cost per unit? Then our standard cost on actual production is how much? 24,000. 24,000. Then we can get our direct labor cost variance as 7,000. No, our direct labor cost variance as 7,000. Then we can identify this as whether is it favorable or adverse one. Then we can identify this as a adverse one. Why I said it is as adverse? Then our standard cost on actual production, that means our budgeted cost on our actual production is 24,000. That means as per our budgeted detail, it should be 24,000, but our actual cost is 31. No, that means we spent more than 7,000 on our labor or the direct labors. Therefore, we can identify this as a adverse variance. Okay, 7,000 adverse variance. Okay, this is a direct labor cost variance. As I mentioned, this direct labor cost variance combination of all of those three variances. No, then let's see how can we calculate these sub variances. That means direct labor rate variance, direct labor efficiency variance, and idle time variance. Then first, direct labor rate variance. Direct labor rate variance. Then how can we calculate direct labor rate variance? As I mentioned, we need to multiply the actual labor hours paid. Okay, actual labor hours paid, we need to multiply it by difference between standard rate per hour and actual rate per hour. Then how about our actual labor hours paid? How about our actual labor hours paid? Then when we come to our actual details, they paid for 15,500 hours. No, they paid for 15,500 hours. That means their actual hours paid is, they paid for how many hours? They paid for 15,500 hours. They paid for 15,500 hours. Then we can multiply it by difference between the standard rate per hour and actual rate per hour. Then our standard rate per hour is, as per our standard details, it is 1,500. No? Then per hour standard rate is 1,500. Then 1,500 minus, how about our actual rate per hour? Then as per the actual details, actual rate per hour is 2,000. No, actual rate per hour is 2000, then we can deduct 2000 from there. That means our standard rate per hour is 1500, then our actual rate per hour is 2000, then we can multiply it by actual labor hours paid. Then we can get our what direct labor rate variance as how much? 1500 minus 2000, we can multiply it by 15,500, then we can get it as 7,750 adverse variance. Why we can say it as adverse variance? Because you can see under the direct rate variance, mainly we focus on deviation about our direct labor hour rate, rate per hour. Then as per the details, then standard rate per hour is 1500. That means we budgeted 1500 per hour, but our actual one is 2000. That means it's more than 500. Therefore, definitely our direct labor rate variance should be adverse one. Okay, then we can identify this as a 7750 adverse one. Otherwise, since we get a negative amount, then simply we can say this as a adverse variance. Then our direct labor rate variance is adverse one, 7750. Okay, then we can calculate direct labor rate variance, actual labor hours paid, we can multiply it by standard difference between standard rate per hours and actual rate per hour. Then our second sub-variance, direct labor efficiency variance. Then how can we calculate direct labor efficiency variance? Then we need to multiply standard rate per hour by difference between standard usage on actual production and actual labor hours work. Then our standard rate is, it is 1500. Standard rate per hour is 1500. No issue. It is 1500. The standard rate per hour is 1500. Then we need to multiply it by difference between standard usage on actual production and actual labor hours work. Then how can we get standard usage on actual production? I mentioned, how can we get? Simply we can multiply actual number of production unit by per unit labor hour utilization. Per unit labor hour usage. Simply we can multiply it by per unit labor hour usage by our actual number of unit produced. Then we can get what? Then we can get standard usage on actual production. Then how about our actual number of unit we produced? We produced 2000 unit. Then we can multiply it by per unit labor hour usage. Per unit labor hour usage. Okay, standard usage. Most important thing, we need to get the standard usage. Then as per the standard details, how about our per unit standard usage? Directly they say 8 hours per unit. No, directly they say it as 8 hours per unit. Therefore simply we can multiply this by 8 hours. Simply we can multiply by 8 hours. Then 2000 multiplied by 8, we can get it as 16,000 hours. That means standard usage on actual production is 16,000 hours. That means if we utilize or if we produce 2000 units, then standard usage on this 2000 unit is 16,000 hours. Then our standard usage on actual production is 16,000. Then how about our actual labor hours work? Most important thing is we need to get actual labor hours work. Okay, then as per the given details, they say actual labor hours work is how many hours? 15,000 hours. Actually they work 15,000 hours. Okay, actually they work 15,000 hours. Therefore we need to get 15,000, not 15,500. Okay, 15,500 is paid hours, no, paid hours. But when we get direct labor efficiency variance, we need to get what? Actual labor hours work. That means 15,000. Then we can calculate our direct labor efficiency variance. Then we can calculate direct labor efficiency variance. 16,000 minus 15,000, we can multiply it by 1,500. That means 1.5 million. We can identify this as a favorable variance. Why? we can say this as a favorable variance. Then standard usage on actual production is 16,000 hours. That means our budgeted one. That means if we produce this 2,000 unit based on our standard usage, it is utilized 16,000 hours, but our actual labor hours utilized is 15,000. That means it is a less than our standard usage. Therefore, definitely we can say this as a favorable variance. Otherwise, then since we get positive amount, simply we can say 1,500 favorable variance. We can say this as 1,500 favorable variance. Then for direct labor efficiency variance, we can get 1,500 favorable variance. Okay, then we can get idle time variance. Then we can get idle time variance. Then we have calculated direct labor efficiency variance. Then we can get idle time variance. It is a simple one. Okay, simply we can get our idle time variance. Then how can we get? We can multiply idle hours by our standard rate per hours. Then how about our idle hours? Then we paid for 15,500. We paid for 15,500, but actually we work 15,000. No, that means definitely there is difference between paid and actual hours. Then this difference we can identify as our idle time. Then we have 500 hours of idle time. Then we can multiply it by standard rate of 1,500. We can multiply it by standard rate of 1,500. Then 500 multiplied by 1,500, we can see it as 750,000. Normally, idle time variance, always we get it as adverse variance. Okay, always idle time variance adverse variance, because idle time is making a negative impact on our performance, no, because we paid for 15,500, but actually we work 15,000. That means definitely it is making negative impact on our business or our performance. Therefore, this idle time variance always we identify as a adverse variance. That means 750 we have adverse variance. We have calculated sub variances also: direct labor rate variance, direct labor efficiency variance, and idle time variance. Then summation of all of those things definitely should be equal to this 7,000. Let's see, it is correct. That means we have adverse variance of 7,750. Then we have positive variance of 1,500, and we have negative variance or adverse variance of 750. Then finally, summation of all of those things equal to 7,000. No, 7,000. That means minus 700, 750 plus 1,500 minus 750. Definitely, it is equal to the 7,001. That means we can it is equal to 7,000. Okay. Then when we analyze these details, actually our direct labor cost variance is 7,000. Adverse one, that means based on the details we can see our direct labor cost is higher than our expectation. But when we further analyze, we can see that main reason for this negative one, or the main reason for this increase, we can identify from our direct labor rate, because our standard one is 1,500, but our actual one is 2,000. But that means our per hour rate is higher than 500, more than our standard rate. No, that means this direct labor rate is the main reason for this 7,000 adverse variance. Actually, when we come to our efficiency variance, actually it is a positive one. That means it is a favorable one. That means we utilize our labor hours lower than as we expected. Okay. Therefore, direct labor efficiency variance, it is a favorable one. That means our usage is good. There is no matter with our efficiency, but main issue is coming from where? Main issue is coming from our direct labor rate. That means our per hour rate, and as well as we have idle time. Okay, then since this we have 750 adverse variance from our idle time, it is also the reason for this 7,000 total adverse reason or adverse variance. Okay, well, like this we can further analyze these variances. Actually, when we this surface, then normally we can see this as 7000 adverse variance, but we further analyze, we can see the main reason for this 7000 variance. Okay, yeah, this is about direct labor variances. These are the main thing that you need to know, direct labor variances. Okay.